Congratulations, we have made it through the first quarter of 2025. Whew, that was a lot. But here is the thing. What are the lessons that we learned and how can it help us to perhaps prepare for what is to come, especially what is to come for tomorrow, April 2nd. This video, we're going to cover what we should expect for April and the rest of the year and the moves that you may want to consider making. Let's go ahead and break it down. All right. There is something called Liberation Day that is quite literally around the corner. So I'm going to give you a high-level overview of what you need to know as an investor and from an economist's perspective. So get your seatbelts ready. It's gonna be a ride. All right. Also, I'm gonna give you at the end of the video what I think is the biggest risk here from the economics perspective, and again, some things you want to at least be aware of from your portfolio and how you may want to consider reacting as an investor. But you do need to know what is going on in the economy, because that's going to trickle up into the stock market, and the stock market is going to have an impact on your pockets. All right. So the first thing is this. The stock market, as of today, at the time I'm recording this, and the market is still open, so this can change by the time you're watching this video, the market year to date is down 4.5%. That is not good. By the market, I mean the S&P 500. That's the largest, roughly, the largest 500 companies in the United States. Why is that the case? That is primarily due to a lot of the chaos that is happening with tariffs, with international policy and trade, so on and so forth. Why is that the case? Because tomorrow, well, first off, there's been a lot of tariffs announced, but tomorrow the U.S. is planning to implement what is called Liberation Day. I don't like the term, but whatever. Liberation Day is supposed to be when the United States announces its retaliation tariffs or retaliatory tariffs on all the countries that have announced its tariffs on us, including China and other countries. Also, the pause that was on Canada and Mexico are going to be lifted. And there is not supposed to be carve-outs. Now, in 2017, 2018, that round of tariffs from the Trump administration, there were carve-outs for certain industries. And that is why those rounds of tariffs didn't really impact a whole bunch of industries except for agriculture, and is why most people don't really remember those tariffs as being that bad. It's also why the Biden administration kept those tariffs intact, and most people didn't know that and didn't actually remember it. These tariffs are different. They are widespread, and again, most of them hit everywhere, okay? And it might hurt all of us, and we will see in the very near future. Also, these are going to be permanent tariffs for the auto industry, and I put that in quotations. He said that himself. Okay, so we will see whether or not he sticks to that, but he says the auto tariffs will be permanent. How will that affect companies like Ford, companies like GM, Tesla, and others? We will see. The expectation is it probably will help companies like Tesla because most of their manufacturing is here in the US. Companies like Ford, GM, and others, we'll see. I would imagine right now, without doing any further research, I imagine it will hurt them. So we'll see where that is going to go. Now, will the stock market fall tomorrow? Honestly, I don't know. This is something that people have known for several weeks now. This is supposed to be something that is quote unquote priced in. Personally, this is not something I would trade for, meaning I'm definitely not going to adjust my 401k. I'm not going to change my portfolio for tomorrow. That honestly does not make sense. This is something that has been in the news and people have known about for quite some time. We have talked about tariffs. I've mentioned this. We've talked about it for months now. This isn't something that's new. Okay, something we have all known and that you could have prepared for. I would not try to overcorrect for tariffs just for tomorrow, but it is something that you should be aware of, and it's going to be an even bigger thing for the market moving forward. So it's at the top of the list. It's going to continue to be at the top of the list, but now it is going to start to be a consumer issue. We've been talking about tariffs hurting the market. Now it could start impacting your pockets. Most people right now haven't really started to see prices go up at the grocery store, at I was gonna say the food pump, but the gas pump and other places. Because yes, oil will be impacted in places like Venezuela and others. So now, unless something changes, which it could by the time this video hits, we are going to start to see that. These are the things that you want to start to pay attention to. Now that brings us into number 2, reduced consumer spending. Now we've already got higher tariffs, right? Presumably higher tariffs, lower stock market. So that's number 1. Now consumer spending. Remember, I mentioned this multiple times, consumer spending makes up roughly 2/3 of the US economy. Our consumer spending and our habits is what helps to, 1, fuel the economy, right? Gross domestic product is the value of all the stuff that we produce. If we stop spending money on stuff, the whole economy, for the most part, collapses, okay? We stop spending money on stuff, these products that we stop buying, that stock starts falling, they have to start letting people go, right? So we have to keep spending on stuff, preferably things that we need, okay? Things that we want to buy, but not overspending, hopefully, right? But here's the thing. If we start to see higher prices on things and we stop spending, then we're going to see this little 4%, 4.5% to be exact, that falling could start to increase. And we do see some technical indicators. That means looking at our chart that has started to, accelerate and showing some red flags that the stock market could start to accelerate and get a lot worse. And if these tariffs are enacted and they do stay in for an extended period of time and you do start to see people spending less, there would be a very good reason as to why a 4.5%, 5% drop in the stock market could very well start to get worse. Now, should you be more concerned? Should you sell everything? Should you hit the absolute panic button? I want to remind you, yes, in 2020, the stock market dropped well over 20%. I think, if I'm doing this from memory, so forgive me if I'm wrong, I'm real close to thinking we, in March, got down to close to 30%, and yes, the market did recover. Also in 2022, the stock market was down almost 20% at the end of the year. If you invest in 2022 to now, especially in the end of 2024, you would have made money. So 5% is not the end of the world, okay? 10% is not the end of the world. I don't like it, you don't like it. Okay, but that doesn't mean that you abandon long-term investing. Okay, it does not mean, I'm gonna say it again, doesn't mean that you should abandon long-term investing, though right now is not great, and what we may experience the rest of this year may not be great. All right, now here's the other thing from a consumer perspective. You may start to see different types of products, and the products that you are using may change. You may also go back to shrinkflation. You definitely want to pay attention to that. Remember, back in 2020 and in 2021, we started to see a lot of companies shrink the size of things and also continue to charge you the exact same amount of stuff. For example, you had a 20-ounce bag of something and all of a sudden it was about 18 ounces and it was still the exact same price. That was what we called shrinkflation. Well, now to save money due to tariffs, because remember, those cost, right? They're going to pay 25% more because it's coming from China, it's coming from all these places, and they're going to pass that cost off to you. Well, if they have to pay it, and they're going to pass it off to you and say, well, wait a minute, if I can make these things cheaper for me, what if I, reduce the weight of this package? What if I don't have, let's just say if it's a box, right? Instead of having, really thick casing or packaging, what if I reduce it by 2 ounces, right? I'm having cheaper packaging here and ship it that way, right? But I'm still charging you the exact same amount and they can continue to keep those margins. Now, if it's just a box, it may not impact you as much, but companies are already starting to adjust those things. Other things like electronics, like toys. My son's birthday was in March. Some things came with batteries, some things don't. Depends on what you buy, but there were things, and some companies are already doing this, where things that used to come with batteries all the time won't anymore. Because why would I spend money on batteries? Remember, if you're shipping millions of products and you're paying 25% extra for those batteries, if I got rid of those batteries, I could save that money and continue producing, continue getting that same revenue and still charging you the exact same amount of money that you used to get. Ta-da, my problem is solved. These are the things that these companies are going to start to do. That is another form of shrinkflation that they are going to start to do, and they've already done this. They've already reported this in Yahoo Finance and other places. So they are going to start to cut corners if these tariffs are put in place and they continue. The bad thing is for us, if they do this for long enough, it is going to become a new standard. And that brings us to risk number 3, and I would argue perhaps the biggest one that threatens the entire economy, and that is stagflation. It is such a big risk that the Wall Street Journal reached out to your boy to talk a little bit about it. Yeah, that actually happened. All right, so I talked about stagflation, the Fed, and everything in between, and I got quoted in the Wall Street Journal. Yeah, that these things happen from time to time. But stagflation is a very unique scenario, and it is very, very difficult to solve. I'm not gonna give you the entire textbook definition, but here's just a quick tidbit. All right. In a stagflationary environment, you have high inflation, which means that the price of stuff is going up. And for example, tariffs, plural, make the price of stuff go up. Okay, that's an extra tax, an indirect tax on you. All right, so you have a tax and stuff goes up. And we have a broad tariff threat right now in 24 hours that's going to make the price of stuff go up. It may not be immediate. We'll see what happens in the next several weeks. Okay, so that is one thing. Price of stuff goes up, all those taxes and things get passed on to you, the consumer. Now, step 2, what happens if you start to see low growth and high unemployment? That is the next thing. Well, we're going to get the unemployment numbers at the end of the week. That's going to be on Friday, and that's going to be previous numbers. So we're going to see what happened, the previous month. That's something we're going to continue to keep an eye on. So watch to see that. But if you start to see people spend less, you start to see unemployment creep up, well, that's not going to be a great thing because you see prices creep up, people not spending, and you really want to get a gap in really things, right? Spending and prices, and that's going to cause an issue because what is the fix for that usually? That's when the Fed steps in and they either raise or lower interest rates, right? Well, what happens if you have low growth and low spending but high inflation? Those two things don't normally mix because in a recession, we know what to do. In a recession, we cut interest rates and encourage people to spend. Well, if you cut interest rates and encourage people to spend and inflation is already high, that makes stuff worse. So you don't want to do that. If you raise interest rates to stop people from spending and make things more expensive, that also makes things worse because you slow businesses down from hiring people, but also you slow things down so people cannot buy more stuff. So what do you do to fix that inflation? That's why you don't want to have it. That is just it. You just try not to have stagflation. There aren't. You could go grab an economic textbook and see what they say about stopping stagflation. You just pray that you don't have it. That's just really it. So you absolutely want to try to avoid stagflation. Now, is all this stuff saying that we're absolutely going to run into stagflation? The answer is no, because we don't know what the unemployment numbers are. We don't know if consumer spending is going to stop or that it is absolutely going to drop off the face of a cliff. That is just the worst case scenario. We do assume that things are going to go up in terms of inflation. I think that's an obvious conclusion. We think that consumer spending will slow down, but will slow down to a point where we think there will even be a recession. We'll see, right? And then step 3 is an even bigger step. So definitely number 1, maybe number 2. Please, Lord, no on number 3. All that brings us down to this. What should you do as an investor? The first one should go without saying, no, it is not time to panic. Can all of those points earlier raise your blood pressure and perhaps get you a little anxious? I'm sorry, but I need to let you know the truth of what's out there, okay? I'm sorry, but reality is I can't lie to you. I'm not known to lie. I need to tell the truth, okay? But that's, those are all the risks that I'm aware of, all right? But as an investor, no, you still should not panic. That is still not a part of the plan. Now, again, I would not start to hyper adjust or overcorrect. We've already talked about some of the stocks and areas of the market you should consider. Another part of this is there are international index funds that you may want to consider, and in some markets, perhaps the European market and others, they've actually outperformed the US stock market. And if you have not already incorporated US index funds to your portfolio, it might be a time to at least consider that and study up on those. They work very similar to, a US stock market fund, and there are non-US stock market funds. A lot of people just forget them or don't consider them at all and assume that the US is the end-all be-all. It ain't, and especially in a time like this, it might be a spot to consider. Now, how much do you want to invest in, places outside the US is totally up to you. We can do more detail into that, but that's also a place that you may want to consider. If you want to learn more about what to invest in, especially if the stock market is down and continues to fall, then you want to check out this video right here.